Larry is the Chief Investment Officer at SFG Alternatives. Larry, thanks for coming on this morning. Always a pleasure. This week, the dollar's been struggling to get above get above and hold above, I should say, that 95 level. Yesterday, PPI came in lower than expected, which didn't help much. But today, we've got CPI. Could a higher than expected number provide that lift that the dollar bulls have been looking for?
You know, I think it could. However, when we look at Beige Book yesterday, look at PPI yesterday, we're just not seeing cost push inflation or any kind of price go through. So with that said, there really is not much of a correlation between PPI and CPI. But to answer your question, if we see something higher than expected, then yes, that could put upward pressure on the dollar. But I'm not expecting it given what we saw yesterday.
Yeah, no question, Larry, and a great point that PPI does not necessarily reflect what we're going to see the day after in the CPI, but certainly it's a big number today, and not only but it's not the only data point to discuss. I want to get your thoughts on the ECB today, because while it's expected that they would leave rates unchanged, I'm wondering if it's still related to lack of inflation that they've been dealing with, because we've also been starting to hear about some growth concerns. Talk to us about what you heard coming out of the ECB this morning.
Yeah, well, I think it's as expected. It's supposed to be doldrums, actually, with tapering in October. And if you look at the forward rate curve between now and September 2019, that's implying the first hike. So it seems to be status quo. I think other than that, we have to keep in mind when you look at like economic surprise indexes, like the Citicorp Economic Surprise Index, we are starting to see positive surprises come out of Europe as opposed to seeing much less of that coming out of the United States. So we might start to see some divergence between the US dollar and the euro right now.
All right, it's like central bank lightning round, Larry. Talk to me about what we had in terms of Bank of England this morning. Anything stand out to you in terms of their decision, because they left rates unchanged as well?
Unchanged as well, and I think consensus expected that. A lot of it is actually in the details, as you know, and something that we have to continue to uncover. Data points are underwhelming. They're going to continue to monitor, but I think they're on track. And this might be a time to start cherry picking on the British pound. That's the first time I've said that in probably 2 years.
Well, British pound's definitely rallying a bit recently, and it's back up to that 130 handle after coming off those spike lows that we saw recently, the 2018 lows. But I want to get your thoughts on some of the news for Brexit, because we've actually been hearing about some progress recently. Has this been what's lifting the British pound, do you think?
Yeah, I think it has. And, there's been such a negative risk premium in the British pound for the past 18 months, at least the last 12 months, that any kind of news that's better than neutral is going to really lift the market, and especially lift the cable against the G10 currencies. And that's what we're seeing right now. It's not like people are caught off guard. It's just that overwhelmingly the market has been bearish on cable, especially since the Brexit vote.
All right, Larry, we talk a lot about this show about trade, the impact that it's having on the indices, but we don't always talk about the impact that it's having on the dollar. Can you just kind of touch on what you've been seeing over the last few months in terms of the dollar responding to some of the trade talks and uncertainties that we've been dealing with?
Yeah, I mean, it's definitely been the year of U.S. exceptionalism, and at some point that's going to have to peter out, but it hasn't. But Ben, I think what surprised me the most is that when you look at emerging market currencies and markets in general, and emerging markets in August, 3 months in a row in the gutter, and in August, keep in mind, the dollar really did not rally, and yields definitely didn't go up. So there's a spillover effect occurring right now, and I'm not sure if it's just a great opportunity to get in, or if it's something bigger that's going to unfold. But that's something that really, really surprises me, that without a dollar rallying, emerging markets continued the setback.
All right, Larry, let's talk about inflation, because we got the number in just 2 minutes here. I'm not sure if you heard me talking a minute ago with my last guest, but I'm wondering, how much of a role does the rise in energy markets have on inflation?
Well, I mean, long term has a big inference, but like right now, the recent spike we've had, I think it's going to be very little.
Okay.
And when you look in the details of all the inflation numbers we've seen over the past 3 months, any kind of inflation we have, it's been on the input side. And so what that's going to do is eventually it's not being passed through to the consumer. It's going to weaken, corporate margins, and obviously impact the stock market at some point. But we're not seeing the inflation. You can see that by the long end of the curve. Always keep in mind the first 1 through 5 years of the Treasury curve is dictated by the Fed. Beyond that, it's inflation, and inflation's just not here.
Larry, I want to dive right into the Treasuries because into the break we were talking a little bit about the 2 and the 5, which recently traded into new 2018 lows. You mentioned these are going to be more closely tied to the Fed, but they certainly have been leading the longer end of the curve a bit lower. I should say the futures lower, yield curve higher. Talk to us about what you've been seeing there in terms of some of that shorter end leading the longer end, and the futures to the downside and the yield curve to the upside.
Yeah, well, what's fascinating is that over the last 4 out of the last 5 trading days, you have the 210 spread and the 530 spread both flattening. Even in this the last data points we've seen, it's really incredible. And I think it just goes more to the notion that the short end of the curve is definitely beholden to what the Fed is doing and what that neutral rate is going to be or supposed to be. When we get out to the 10s and 30s, it's more about duration. It's more about inflation and perceived inflation. And today's 30-year auction is going to be a good truth teller for that. Like, how much appetite is there for duration right now, given the question mark over medium-term or even long-term inflation prospects?
All right, Larry, let's take a little bit of a look at Treasury's reaction to the number. First, let's pull up the CPI number. Got released here just a few minutes ago. Let's take a look here, and then I want to get your thoughts on it. You're going to notice here, for the most part, much like PPI, came in a little bit lower than expected. You're going to see there, traders, we have the number up on the screen for our viewers here, Larry. They can see 0.2% was the actual number. They were looking for it to come in 0.3%, the year-to-year at 2.7%. Again, across the board, it looks like the core, Larry, on the month-to-month came in a little bit lower expected. So did the core on the year-to-year. Similar situation to what we saw yesterday in reaction to PPI. Treasuries are rallying, but I want to point out kind of limited here, though, Larry, for the most part.
Yeah, it is. And, it's just been a common theme. And I hate to use the word cost-push inflation 3 times in one segment, but that's the lack thereof. And that's what we're not seeing in any of the numbers that have anything to do with inflation. So that's going to continue flattening the 210 curve and or the 530 curve. I wouldn't suggest anything other than that. It's just one of those things that we're just not seeing the inflation pass through the way the Fed and or consensus hopes it would.
All right, Larry, I want to get your thoughts on, there's been a lot of attention this week on the Treasury auctions. We had the 3-year on Tuesday, yesterday the 10, today we got the 30s. What are your thoughts on the type of response that we saw?
Yeah, well, so far the response has been absolutely terrific.
Okay.
I mean, it's really blown my personal expectations away. The 30-year I typically don't care about, but I really do care about it today because, like, with the the pension slash tax schemes that are embedded in that auction, how much appetite is there for duration from the pensions, et cetera, et cetera. I'm really going to be interested to see how that plays out, and it's going to definitely impact how I trade the yield curve going forward.
All right, Larry, I want to talk a little bit about this week. Again, as I mentioned a minute ago, we saw the new lows in the 2-year, new lows in the 5-year. Should we expect a repeat of this spring? We saw the 2 and the 5 leading lower, and while they were extremely reluctant, again, as I mentioned a minute ago, eventually the 10 and the bonds did join in. I'm wondering, for one, should we expect them to eventually, and also what does it mean for you to see the longer end, which for the most part staying pat, potential here for market inversion?
Yeah, I'm definitely calling for inversion, and that to me does not mean recession this time. I mean, there's a chance of recession, but does it mean like market meltdown? I don't think so. It's just the velocity of money is enormous. The savings rate is large. Real interest rates are still negative. So it really is 2 different parts of the yield curve, and we have to look at them independently. And I know the news headlines scares people into thinking that inversion means market debacle. It doesn't have to, especially this time. We have to keep in mind, this is a monetary experiment that has never been tried before in history. And so using history as a guide, probably not the best measure.
Yeah, certainly embarking on uncharted territory here, as I like to call it. Larry, for me, the long end of the yield curve not joining in means that fear, well, at the very least, is short term right now in terms of magnitude and duration. But what does it tell you to see the longer end of the yield curve, the Treasuries not participating?
You know, that's a great question. I have not. I really all year long have called for a 275 year-end 10-year yield. I still think that's achievable. Up here around 3%. What it tells me, it's hard to say because they're following the boons right now, and they need to follow the boons. And so without a reaction there, it's going to be really hard for the long end of the curve to get much higher than it is unless we have runaway inflation, and that would be bad as well. So it's so mixed up with so many different complicated pieces and parts that it's hard to explain in one sentence. But to me, it just says status quo right now, and stocks are still the buy compared to bonds.
Larry, a lot of ups and downs associated with some of the trade concerns, and equally as much with some of the emerging market unease and uncertainty there. But is it the credit markets that we should be watching to provide that real indication in terms of whether or not these concerns are legitimate? I mean, ultimately, we would see bond yields spike if they were correct, and until then, for the most part, just news, just headlines?
Yeah, Ben, I think you're spot on. You have to watch credit spreads,
okay,
and they're not nearly as wide as they should be if we were having a disaster on our hands. And you know, who knows how this will all play out? We just don't know. When it comes to Europe, they're a lot more dependent on Asian emerging market currencies than the U.S. dollar is. That's a fact. But beyond that, deep down inside, my conviction is that the market somehow believes that this will all wind up to be some type of compromise, and that at least on our president's side of things, I think he'll take his foot off the gas once he starts seeing that's hurting our economy.